All right, everybody. Ignatius Jackson CPA here with another video for you on my YouTube channel. So today we are excited to have a guest on the YouTube channel. This guy is another CPA, and he is really deep into real estate knowledge and tax saving strategies and cool stuff like that, as well as self-directing, your retirement accounts and things of that nature. And so excited to have Ryan Bakke, CPA, here with me. I don't know, Ryan, if you want to maybe just introduce yourself a little bit to the audience.
Yeah, my name is Ryan. I went to school for accounting and finance. Never really too good at math, but I fell in love with accounting, numbers, time value of money, being able to put together it in Excel, as well as see just how powerful compound interest is. And I knew this is sort of the field that I wanted to be in. I spent about almost 2 years in Big Four consulting, working at a firm doing investment management tax. And then I left because I decided I wanted to work for a bigger mission and work towards something else. And I want to inspire other people. So I decided to open up my own firm. And that's what I do now. I release educational content, as well as I run a CPA firm focused on real estate investors primarily. We take all clients, but you have to own real estate actually to work with us. So we only deal with people who own real estate.
That's awesome. That's awesome. I have a similar philosophy in terms of owning a business. To be one of my clients, typically, you would need to have either a business or some real estate going on. And so that's an interesting take that you only do real estate. Before we hop into the topic, maybe I am just a little bit curious as to why maybe you and your firm and what you're doing decided to go that route versus also focus on just general business owners.
Mm-hmm. Yeah, I think with real estate, especially if you look over the last 20, 25 years, there's been no other asset class that's outperformed real estate. And the multiple ways that you can make money in real estate, as opposed to, say, the stock market or owning other types of businesses, I think there's nothing that compares to real estate in the form of appreciation advantage. You get loan pay down, equity pay down. There's tax benefits with real estate. Real estate's an inflation hedge. There's so many benefits to investing in real estate that you just don't get with other investments. Now, I'm a fan of investing in general. I'll be the first person to tell you to put money in a Roth IRA and get that thing in index funds. But I also love real estate. And I always say this, I think equity gives you options, but cash flow gives you freedom. And the fact that you could save all this money for retirement, and you could save your $500, $600 a month, but that's equity. And equity, it's not going to feed you until you're 59 and a half, unless you want to pay a penalty. But cash flow through real estate will feed you, your family, and it'll allow you to retire early.
No, that's a very fair point. I really appreciate that perspective and thoughts. And I do definitely encourage a lot of my clients to invest in some real estate as well. If you think about it, most of the rich people, if not all of them, that are in the country own some portion of real estate. So whether it's, an actual property that they own directly, or if they're invested in some type of real estate investment trust or some other syndicates or whatever that might be out there, they're involved in real estate to some capacity. And so it makes sense what you're saying. And so especially if you're working on building people towards generational wealth and help them to reach their goals of maybe retiring early, or maybe just not having to work as much as they age, and like you said, having that cash flow to be able to do that. So it's pretty awesome. All right, let's hop into our first topic that we wanted to talk about today. So the real estate professional status. This is a topic that we hear a lot about, and I know you hear a lot of crazy stuff that people get told. It's even, I think, on TikTok quite a bit, where you got these people talking about crap that don't know what the heck they're talking about. And so that's the first thing I just want us to kind of touch on and go through, and maybe if you could high level, just real quick for us, explain what the real estate professional status is, what it means, and then maybe I'll hop into how you can qualify for it. So
Yeah, so broad level, real estate professional status is an IRS tax designation. that's given to people who spend a ton of time in a real property trader business. So this is for your real estate agents, your flippers, your wholesalers, property managers, even people who spend most of the day working in real estate. Now, this is not for a CPA. I cannot qualify, but this is for your person that spends a ton of time in real estate. And the notion is you're able to use your passive activity, your rental properties, your commercial buildings, whatever sort of real estate that you own, use losses from those properties, because we know that rental properties generally show a loss because of depreciation. The ability to be able to use those losses to offset some of your W-2 income or your business income, whatever you have going on in a trader business throughout the course of the day, you're able to offset that with your passive losses. So to give you a scenario, I have tons of clients that own real estate brokerages, are fixing and flips, are doing wholesaling, $150,000, $200,000 of income, and they have rental properties that are generating the same amount of losses. So they're buying rental properties, generating losses with those. And again, these losses are not cash losses. These are tax losses. So your rental property cash flow wise, you're showing a profit, but you get to turn around and tell the IRS you have a loss. And they're able to use those losses to offset their incomes. So somebody who's able to wipe out a $250,000 tax bill, there's the $250,000 income, they're saving $50,000, $60,000 in taxes every year by qualifying as a real estate professional.
No, that's exactly right. And you're exactly right with that point. And that's the whole point of the real estate professional status. And although you're correct, as CPAs, we likely will not qualify because we have a full-time job that is outside of real property trader business. You could have a spouse that maybe qualifies if that's their profession, right? And they don't do any other activities that would make them not qualify for that. So that's something to kind of look at for some of the people who are clearly not real estate professionals themselves, but maybe their spouse could potentially get them to that point.
Yeah,
so,
that's a common strategy too. You have a high earnings, one high earning spouse, and you have a spouse that maybe stays at home, and that spouse, they just need to get their 750 hours in the real properties that they own, and good to go. And one interesting caveat too is non-investment income tax. Real estate professionals don't have to pay non-investment income tax, which is also pretty cool. That's a 3.8% surcharge on any sort of investment income over a certain threshold.
That is a nice bonus. That is correct. Although they were trying to potentially maybe change some of that with the horrible bill that didn't get passed, thankfully. So the Biden tax plan, as I like to call it. So that's another good point, though. Let's touch on the qualifications then. So to qualify as a real estate professional, Ryan already mentioned one of them. The basic qualification is that you have to have 750 hours in a real property trader business that you work on an annual basis. Okay. So basically what that means is a lot of time, right? So if you think about it, 750 hours is a lot of time they have to put into it. So you need to make sure you meet that threshold. You definitely want to make sure you have a time log to support that as well, in case you ever get audited by the IRS. For that status qualification, you want to make sure you have that documentation to support it. Okay. Now it also, and this is the part that a lot of people miss, has to be your primary occupation, basically. So it means you don't work any more hours in any other occupation than you do in that real property trader business occupation. Okay. And so that's the part I think a lot of people sometimes miss. They're like, oh yeah, I spend 750 hours a year doing this. Yeah, but do you also have a full-time job? Like we were talking about earlier, us being CPAs, we have full-time jobs where we're doing other stuff besides real property traders businesses. So it's not our primary time where we spend our primary time, our primary occupation, basically. And so we're not going to qualify in and of ourselves as real estate professionals typically. Okay. And once you meet those two thresholds, which I'm going very high level here, we're going to dig into a little bit of the details here on this. But once you meet those two thresholds, then you also have to be materially participating in that real property trader business as kind of a third qualification, meaning you have to spend enough hours in the real property trader business actually participating in order to meet that qualification threshold of being a real estate professional. And so all in all, not as easy as you might think to qualify for it, but super advantageous if you can qualify for it,
Mhm.
basically. Okay.
And yeah, I
Go,
was
go.
just say it's practically impossible. There's actually only been one guy in the history of case law, and it was a case called Miller versus Commissioner, where the taxpayer was a boat captain for his day job, and he was actually able to qualify. He said that he spent about 700-800 hours being a boat captain, and then he spent more time in real estate than his boat job. And he had people testify to his credibility. He had friends, family testify, but it's virtually impossible to have a job that's in a non-real estate field and qualify for this.
Yeah, no, I hear you. So definitely. Can you maybe break down for people, Ryan, what are some of the real property trades or businesses that count? You know, what types of fields are going to
Mhm.
qualify as a real property trader business?
Yeah, there's 11 different types. I don't know all 11 off the top, but wholesaling, fix and flip, property management, brokerage, those are the type of properties. Those are the type of activities that are going to qualify. I don't have all
Yeah,
11 off the
I,
top,
I
but
don't have all 11 off the top of my head either. So more so just like a high level summary. Um, Long story short, people, if we didn't say this before, let me just be clear now. Even though you're watching this video, we're going through some of these qualifications, you need to work with the actual CPA or lawyer, tax lawyer that understands the qualifications here and explain your situation and make sure you actually qualify
mhm.
before you try to take this designation, because uh, it's very litigious. A lot of tax court cases on it. The IRS has a pretty good batting average in terms of winning whenever they go against someone in this area. And so it's not an area where you want to take that risk without having a little more comfort and confidence that you actually qualify for it. Just to save yourself some money on taxes, because it could ultimately end up costing you a lot more in taxes if you claim this status and they end up denying it and showing that you actually were not eligible. You got all kinds of penalties and interest and everything on top of that that you're going to have to pay. So it could end up costing you more than what you were going to pay initially. And when it's all said and done, because usually these things don't get litigated for a good 3 to 5 years once you file your tax return. And so
Mhm.
during that time period, all that stuff is accruing in terms of your late payment penalties and interest and all that kind of stuff. So, but yeah, like you said, real estate agents are a good example of people who tend to qualify for this, brokers, things like that, wholesaling, flipping. Those are all kind of real property trades or businesses that you can utilize to qualify. Here's an interesting one. Well, I don't know what you think about this, Ryan. What about mortgage loan originators? Are those guys going to qualify if they own their own business?
I think we actually got a few court cases about that, and I think they've gone back and forth. I think in some of them they've allowed them, and then some of them they disallowed. So
Yeah.
it's almost a top. I think it really depends on how in the weeds you are, because it's the same thing as like a real estate attorney, right? Maybe they might spend all their time doing real estate tax law, but are they actually, what are they, the substance of what they're actually doing is not real estate. It's a complement to real estate. Same thing with brokering in real estate and
Yeah.
loaning money. It's the art of loaning money just so happens to be the art of loaning money to people who buy real estate. It's real
Yeah.
estate, but the actual substance of what they're doing. So I believe the tax courts have kind of tossed it up. Sometimes they allow it, sometimes they don't.
Yeah, you're exactly right, and that's why I brought it up. I'm like, so that people understand that it's not always black and white. There's a lot of parts of this that are going to be pretty black and white, but there's some components that could be a little gray in terms of if what you're doing is a real property trader business. But there are a lot of court cases that we can go to look at to see how they treated certain facts and circumstances to try to determine, whether you qualify or not for that particular field. So
Mhm.
nevertheless, it's something that we just wanted to touch on. Now, in terms of the material participation component of this, right? So in order to kind of take, those rental losses that we're talking about against your ordinary income, you have to be materially participating in that rental activity, basically. And so in terms of qualifying for that from a material participation perspective, there's, what is it, 9 tests?
7.
Seven, excuse me, 7 tests they look at to qualify for that. But really there's primarily 3 that most people are going to utilize, right? And so I don't know if maybe you can touch on those and what those 3 tests are that people
Yeah.
will typically use to qualify for the material participation component.
Yeah.
Assuming that they make the 750 hours and it's their primary
Yep.
occupation, now we have that third test of qualifying for that.
Yeah, the gold standard that I say is 500 hours. If you can prove that you spend 500 hours material participating in your properties, you're going to qualify. You have to keep a time log of your hours. But this is important is you don't actually have to keep track of anybody else's time. If you can prove 500 hours of your time, you're golden. Now, the why I say that is because the next other test is 100 hours and more than any other person. So if you have a cleaner, a contractor, somebody that's working in your property, for this second test, you have to prove you've spent at least 100 hours and your time is more than anyone else, which would require you to ask that person or get a time log of that person's hours, because you need to prove that you not only did you spend 100 hours, but your time was more than any other person. And I've gotten a lot of questions about this recently. And in some recent tax court cases, they seem to refer to a cleaning. Let's say you have a cleaning company, but there's 3 cleaners. They've referred to the company aggregate as an aggregate. So you're not beating out each cleaner's hours. You had to beat out those 3 cleaners' hours total. But same, like let's say you had 3 different cleaners who were not in the same company. You just have to beat them out individually. Very nuanced. That's the second test. So 100 hours more than anyone else. That's the one that most people hit. That's the one that most people can get. The third test is substantially all. This one is very dicey because if anybody else steps foot in the property, you're immediately, you don't qualify. If anybody spends any amount of time. So for this test, I could spend 50 hours. I could spend 60 hours. I could spend 95 hours. Just so as long as I'm performing all of the activity, substantially all the activity, I'll qualify for that third test.
Yeah, no, that's exactly right. And it is the material participation component. I don't know about you, but oftentimes when I'm talking to clients about this and just other professionals in general, I feel like for some reason that one's often forgotten about. That's a requirement, or it's kind of like an afterthought in a certain circumstance. And so that is a really important component of ensuring that you qualify for the real estate professional status. Is making sure you meet that material participation test. And like you said, if you just have 1 or 2 properties, very, very hard, nearly impossible for you to meet the 500-hour test. So you're really going to be shooting for one of those other 2 tests that he mentioned. But if you own a massive portfolio, let's say 10 properties or more, then you could reasonably meet that 500-hour test, in that sizable portfolio. And maybe you own an apartment building and outright, and you spend a lot of hours managing the apartment building. You could do it in that circumstance as well. Now let me throw this out there as well, Ryan, to see your thoughts on this from a property management perspective. So I hear some stuff sometimes, like people are like, you don't have to include those hours. You do have to include those hours. What say you? I mean, when you have a property manager involved in your property that does most of the day-to-day activities, do you think you're really going to qualify as a real estate professional in those circumstances?
No, and the IRS makes that pretty clear in the passive activity loss technique guide. It's like a 157-page document. I've read it frontwards, backwards, sideways. And it pretty much states in there a few times that if there's evidence that there's a property manager involved in the management, you're likely not going to qualify. You're almost not going to qualify, because the argument is you can't have your cake and eat it too. If you're going to hire a property manager, you're hiring them to do something. And if you at the same time say that you're spending more time than they are, I find it hard to believe, because what exactly are you paying them to do? More importantly, if you have a property manager, that means you're not involved in the day-to-day operations, which means investor level hours do not count. So time spent analyzing financials, bookkeeping, cashing checks, investor level hours do not count if you're not involved. They only count if you're involved in the day-to-day operations, and you cannot be involved in the day-to-day if you have a property manager.
I agree with you 100% on that. I've always believed that to be the case. And there could be a situation, I'll just kind of play devil's advocate a little bit, There could be a situation where if you have a massive portfolio and you have a property manager involved, even just because you have that property manager involved, you could get there potentially because your portfolio is so massive that you are spending enough time to
Mhm.
meet the 500-hour test still. But outside of that, yeah, I mean, there's a good chance that you're probably not going to meet that qualification, especially if you only have one or two properties. That's pretty much a slam dunk, no brainer,
No way,
not going
right?
to qualify.
Yeah. Now,
So, yeah,
let's say you had 7 or 8 and you spent time in 5 or 6 of them. You got your 500 hours between 5 or 6 of those
yeah,
properties. You can make an election to group in the other property with those in order to meet your hours test. So, on a standalone basis, you're cooked. You're not going to get it. But aggregating them together, making what's called a -9 election, you're able to group them for these material participations. So you can have properties that are ran by property managers and still qualify. So as long as you're meeting your hours test somewhere else.
and you actually stole one of my next points. Is so that's awesome that you brought that up. That's a very valid point. Okay, and that grouping election is essential, especially if, let's say, you also are doing some REITs, real estate investment trust investments, or some syndicates or something like that. You can actually group all that together as long as you have enough properties where you're spending enough, material participation hours over the 500-hour test, amongst enough of those properties. Now you can kind of group everything together and start accumulating all that stuff and adding all that together. And it's all considered basically one real estate enterprise, essentially,
Mhm.
which is super, super cool and powerful as well. That benefit exists. So I'm glad you brought that up. That's an awesome, nifty strategy. Because without that grouping election, you do have to meet the material participation tests on each individual property that you own. And so that can become not only is it a pain in the butt keeping track of everything, but proving it is also a pain in the butt. So
Yeah,
you
right.
have to go through that test for every single property you have. And you might meet it for one property and not meet it for another property. So you're SOL on this property, but you're good to go on this property. Whereas if you had grouped everything together and in total you meet the 500-hour test, you're pretty much golden at that point.
Mhm.
So awesome.
Good stuff.
Awesome. Anything else you could think of that we need to touch on the real estate professional status before we hop into talking about short-term rentals and things that we're going to talk about next, right?
Yeah, I think the big thing is you just have to be credible in front of the IRS. So when you're keeping the documentation in your time log, it has to be reasonable. The tax court doesn't live in a vacuum, and they know how much time it spends to complete task. So in one court case, the Lee versus Commissioner, actually, the taxpayer stated that it took them 56 hours to install a toilet. Now, I don't know about you, but I'm not too handy myself. But I know damn well that if I went to put in the toilet, it wouldn't take me 8 working days,
Yeah.
7 working days.
Yeah.
And that same taxpayer also said that it took them 200 hours to close out their year end books. I'm a CPA. I close out my books in like 20 minutes. I know I'm a CPA, but it doesn't take 200 hours to close
Yeah.
out books. So you
No.
just have to make sure that the hours that you're documenting, they have to be credible, they have to be reasonable, and you have to be able to substantiate them. And you want to do it now, because if you go and create what's called a retroactive time log, there's no way you're going to be able to know exactly what you were doing 3-4 years ago. And the IRS, they will take a time log, but they'll note in the file that you created it while you're under audit. So there goes your credibility.
Yep. Absolutely. And that's key. That's so key. I'm glad you brought that up and stressed the importance of that time log, because that's the part that people don't ever want to do. I mean, when
Yeah.
you're trying to get the benefit of being a real estate professional, but you don't want to put in the work to qualify for it. And you can't have your, like you said earlier, cake and eat it too, basically. I mean, you got to put in the effort and the work. And if you're getting advice from a CPA and they're telling you, well, you have to have a time log, just because I don't ask you for that time log every year, I expect you to still have it. And you should know by now, especially if you've been doing this for a few years, that you need to have that time log in place. It's not up to us to verify every single piece of information we're doing your tax return. But as long as we believe that you are putting that due care in, it's the worst thing ever when you go to, if you get audited for doing this real estate professional status. And that's obviously the first question. One of the first questions I'm going to ask you for is, hey, where's your time log? And you say, oh, I don't have one. That's like the worst thing ever. And so, yeah, just make sure you have one. I mean, you should be doing it contemporaneously throughout the year, right? That's the official word that people like to use. But at the very least, you should have it done before you file your tax return.
I actually require it before I submit tax returns.
Yeah.
I actually require it for my clients now. I don't submit a return unless I see a time log.
Unless you see the time log?
That's not me being rude or the big bad wolf. Because it's not up to you. It's not up to me. It's not even up to the IRS. It's up to a tax court judge who's been practicing case law for over 30 years. It's not up to any of us except that him or her. So your time log has to be credible, and I make my clients have it. Otherwise, their return doesn't get submitted.
That's probably a good policy. That's probably a good policy to have in place. So, all right. So next topic I think we want to touch on is short-term rentals. I know you're really passionate about this as something that can help people save money. And so this is a great area of the tax code that I also feel like a lot of people miss, quite frankly, especially professionals as they're talking with their clients on saving the money on their taxes of the tax code in terms of saving money from a real estate perspective, in terms of the short-term rentals. I don't use it that often with my clients just because of the nature of the market that I'm in. Usually doesn't prove to be too fruitful. But that said, I'm sure there's some places where this could make a lot of sense in terms of utilizing it as a strategy. And I know you use it quite a bit for your people. So just wanted to kind of open it up to you to maybe break down the benefits of the short-term rental exception to the real estate professional qualification status, and you receive basically some of the same benefits that you would if you were a real estate professional. Mm-hmm. So if you can jump into that.
Yeah. So the underlying notion is passive losses can only be used to offset passive activity gains unless you qualify as a real estate professional. And that's in section 469. That's been the rule since 1980 or 1993. That's been the rule since when they adopted real estate professional status. But there's actually a carve out to that rule that's found in, I actually have in front of me, Treasury Reg section 1.469-1T E32 cap A. And it says that an activity is not a rental activity under section 469 if, and then there's 5 exceptions. The first one is the average period of customer use for such property is 7 days or less. And this is the one that I use all the time. So if you rent a property out where the average guest stays 7 days or less, it even rhymes too. Average guest stays 7 days or less, then you do not have a rental activity under section 469. Okay. So you're able to abide or move away from the section 469 passive activity loss limitation rules in regards to you don't have to be a real estate professional. So that removes number 1 and number 2 from our test qualifications. However, it's still on a Schedule E. We're still going to call it a passive activity, and you still have to materially participate. We can do away with test number 1 and 2, but you still have to materially participate using one of those 7 tests. And the reason for this is the whole difference between the Schedule C and the Schedule E treatment when it comes to short-term rentals. And in my opinion, as well as from what I've derived from IRS publication 527, as well as some of the tax citations, a short-term rental goes on Schedule E unless you provide substantial services such as cooking, cleaning, while the guest is staying there. Most Airbnbs do not rise to the level of substantial services. And so we can achieve the outcome of using the loss to offset our W-2 or our business income without having to qualify as a real estate professional. We just have to prove that number 1, the average guest stays 7 days or less. And number 2, we materially participate in that activity.
Yeah. And that's key. So if people, let me maybe break that down for people that don't understand the difference between Schedule C and Schedule E. Schedule E is awesome because of one main factor. You're not subject to self-employment taxes. It's bad in the sense of a lot of the stuff that goes through Schedule E is by default a passive activity, with the exception of S corporation and partnership income that flows through. That can generally be by default
Non-passive.
active, as long as you're, again, materially participating in that business. But for the most part, the negative part is it's passive on Schedule E. The positive part, not subject to self-employment tax. If it goes on Schedule C, you're going to be subject to self-employment taxes on that activity, and it could still be potentially passive in nature. You just never know. But yeah, substantially participating is important. Materially participating is important to that factor that he was just talking about in terms of the short-term rentals. And we want to make sure that what you have it in the right place, because you don't want to put it on Schedule C thinking, oh, well, that automatically just makes it active income, and we can just write off everything that we want to write off and utilize it against all of our other ordinary income, when you don't really meet the definition of putting it on Schedule C. It could present a challenge for you at some point in the future, because I have seen some people who do that. They'll just throw their short-term rentals on Schedule C thinking, oh, we're good to go, it's on Schedule C, I'm paying self-employment taxes, everything's all hunky-dory. But it could still present some challenges for you if someone starts doing some digging on where that income came from and finds out it was from a rental activity. You still have to prove that material participation test in order to be able to write off the losses. So
Because if it goes on a C, you basically abide by the 469 treatment, and at that point you only worry about at risk basis, Section 465 at risk, as well as 461L excess business loss limitations. So you just moved what was a passive activity in which you would have had to materially participate to a non-passive activity by putting it on Schedule C. And that Schedule C loss will offset your W-2, whatever else you got going on all day long. And it's super simple for people who prepare their return themselves to just check that box or put it on that form. Anytime you're going to drop a loss on a tax return, you really have to make sure you qualify. There's 4 different limitations in order to be able to deduct a loss. And there's different code sections for each limitation, and it is crazy. But if you get anything out of it, is if you're going to deduct a loss, especially against high earning income, you got to make sure that you qualify for it.
Absolutely. So, and you bring up a really good point in relation to the passive activity rules. And I didn't really clarify that at the beginning, but the real estate professional status is also a way to get around the passive activity rules, basically, in a nutshell. That's kind of one of the reasons why we're doing that. So both these strategies, the short-term rental as well as the real estate professional, are both ways that we can get around the passive activity rules that he mentioned in Section 469 of the tax code, and still receiving the benefit of having those losses without having to pay self-employment taxes in a lot of cases is pretty sweet. So that's kind of the crux of that. Anything else that we need to touch on in regards to either short-term rentals, real estate professional, anything like that, before we hop on to a couple other topics?
Cost segregation.
Oh, well, obviously.
Yeah.
That's one of the main reasons that we're doing that, right? So maybe touch on the cost seg and the power of that. And obviously that's one of the biggest ways that you create losses in real estate. So let's touch on that.
Yeah. So when you purchase a real estate property, short-term rental, long-term rental, the IRS pretty much assigns it a value. And you can think about it as a form of a loan. So if I have a $390,000 building, let's say, and it's depreciated over 39 years, the IRS is going to give me $10,000 worth of depreciation every year for 39 years in a form of almost a loan. I think of it as a loan, and they're going to give you a depreciation deduction for that amount every single year. And you can choose to accelerate the depreciation by getting a cost segregation, breaking out the components of that building structure and accelerating that depreciation sooner. So instead of getting $10,000 a year for 39 years, you might get $60,000, $70,000, $80,000 in the first year, and then say $6,000 for the remaining term of the building. But the idea is you're able to accelerate some of that loan in the form of depreciation, and you're able to, and then that combined with real estate professional status or short-term rentals is huge, because now you can take that tax loss against your active income.
That's exactly right. And cost segs are awesome. I've talked about this on a podcast that I'm part of a lot of times. And the one thing I will say about cost segs, though, you do want to just make sure that the source that you're using for your cost seg or analysis is a valid source. So your CPA shouldn't be doing this on their own. You shouldn't be doing it on your own. You should be using some kind of third party valuation or appraiser or some company that specializes in this field that can actually take the building that you purchase and segregate the components of it in a IRS approved, not necessarily IRS approved, but a manner that's not going to result in you having to pay more taxes if you ever get audited by the IRS or the state for taking that cost segregation amount and additional depreciation that first year. So just something to kind of think about and consider. The other thing I will say is for, oh gosh, I think this is the last year already.
Yeah, it is.
You 100% bonus depreciation right now. So yeah, so right now for 2022, we still have 100% bonus depreciation allowable for assets that have lives of 15 years or less. Actually, I believe it's 20 years or less,
20.
but there's not very many
20-year
life assets out there. So most assets are going to be 15 years or less that you get from your cost seg. So from that standpoint, there's still that ability to take the bonus depreciation for this year. And then next year, doesn't it drop back down to 50%?
It goes to 80,
80%?
60, 40, 20, and then zilch.
Okay. And then zilch. So yeah, so we're starting to taper off from the 100% bonus depreciation starting next year in 2023. So this is a fantastic year. If you've been thinking about buying a piece of real estate and maybe implementing some of these strategies, this is a great year to do that because of that 100% bonus depreciation eligibility. It's super beneficial, and you're going to really maximize your savings this year. Okay. And if you also had some stuff in 2021, because we're just barely starting to start tax season for 2021, if you had already previously bought a property, even if you bought a property sometime in the last 2 or 3 years, there is a way that you can actually take that cost seg and do an adjustment, a retroactive adjustment for a previous tax year that had already been filed. And if you haven't filed 2021 yet, which nobody should have filed because they haven't really even started accepting returns yet, for 2021 tax year, you still have time to do the cost seg before you file your 2021 taxes as well. Definitely something to talk to your CPA about in terms of the timing of doing the cost seg, because obviously if you don't have a whole lot of income, it may not necessarily make sense to do the cost seg in a particular year and vice versa. So maybe it makes sense to, you're going to have a lot of income in 2022, but you bought a property in 2021. Maybe you don't take it in 2021. Maybe you wait until 2022 to take it and you do that retroactive adjustment to catch up on the cost segregation. So just some strategies and things to think about in terms of cost segs and qualifying as real estate professional versus short-term rentals as well. So I think we're about at time. We did have some other topics we wanted to touch on and cover. So what I think I'm going to do, assuming that Ryan's cool with it, is maybe have him back on the YouTube channel in the near future to cover some of the other topics we want to touch on in relation to real estate, because he's a wealth of knowledge. I'm a wealth of knowledge. Between the both of us, you're going to get a lot of good information. I feel like it's a super powerful way to get some info out to you guys. Yeah, I don't know. Does that sound good, Ryan?
Yeah, I would say it's worth the price they pay too, right? I mean, it's...
yeah, free. Yeah. So yeah, he brings up a really good point. Like some of this stuff that we're talking about, if you were to come to us and want to do a consultation, whatever, we'd be charging whatever our normal rates are to do something like that and to just educate you on this. So this is a nice, quick, easy, free video. Again, we didn't dive deep into the requirements. there's so much literature and guidance. There's no way we could hit everything in this 30 minutes, 40 minutes, however long it's been that we've been talking about this. This is something that I've seen some people that have done a series over like 4 or 5 hours, and you still haven't even hit everything in relation to this. So I will say that one of the things I'm going to be working on here in the near future is I'm actually going to create a little real estate course that people can attend for those that are local here in Arizona. And we may do a virtual component to it too. We'll see. So that will be something that's coming out in the near future. So keep an eye for that. I'll be sending it out through my channels and whatnot. I don't know, Ryan, do you have any other educational materials that they can, the courses are for a fee, by the way, but it'll really dive a little bit deeper into stuff. I don't know, do you have anything yourself in terms of education, additional education you do or anything like that?
Yeah, I have a few webinars that I attended. Well, I have webinars that I've done, and I've also attended live in a few events. Those links are free. I have them in my bio. I got a Facebook group, Tax Strategies for Real Estate Investors. We got over 2,000 members in there now, talking about tax strategies every day. And I am coming up with courses soon too, also. So that'll be on my horizon.
Yeah. I mean, this information is so important. I mean, but at the same time, we're both business people, so we got to make sure that we're receiving our benefit from it as well. And so, we'll be sharing that information with you guys. As his course is available and my course is available, I'll be sure to leave it in the comments on the YouTube channel and everywhere else that this might be posted out there, and we'll kind of go from there. All right. Awesome. All right. Well, thanks, Ryan, for joining us today. And this has been another episode on the Ignatius L. Jackson CPA YouTube channel. We will be back with more with you guys in the near future. Hope everybody has a great day.